good evening, everybody. I think very welcome to this budget-related webinar. We've been having it for the last few years. And so thank you all for joining again. I know that on the budget day, on the media, plus also later on in the electronic plus print media, there's a deluge of information which keeps coming to all of us in our mailboxes. But, it becomes sometimes very cold, very impersonal. It's much better to, hear it from the experts who can summarize it, tell us a distilled version of what all happens going forward. The interpretations always are very key and very questionable at times and very different at times. So, I've been getting so many of them, and I will read through. Someone is absolutely over the moon, talking in terms of the budget, praising it. Other people are critical. So I think the truth is always somewhere in the middle. So I think we need to determine and find that today. So thank you, KPMG, for being with us for the last so many years. I also thank my colleague and fellow Dutch Indo-Dutch Chamber executive from Bangalore, Rob, who's here representing the Bangalore chapter of the Indo-Dutch Corridor. And I should also thank BLBA, the Belgium Luxembourg Business Association, who's also a partner today. And they've also been joining us in quite a lot of events actually in the past years. So thank you, Rajiv, and thank you, colleagues from BLBA. I know we have a lot of information right up there and where the KPMG colleagues will punch in. And I'm leaving a little bit of sunshine to Rob, who will introduce the speakers in a while. I won't take too much of time. I just have, let's say, some 3 or 4 quick questions, which I will leave on the table for the KPMG experts to deliberate on. And I'm not getting into numbers and all that. They will rattle off anyway, but a little bit more subjective and more qualitative question, which I must raise. So the first one is that, is the India's tax structure really progressive, as has been claimed? The number 2, which is very important again, is this tax regime conducive to private investments in the country? And that is something which is need of the hour always, and more so now. The third question I have is the tax regime discouraging social initiatives, because there's been so much of talk on NGOs and enterprises being taxed or over-regulated in the country for good or bad reasons. But we all know that that's been one of the progressive fronts in all developed countries. So what's happening in India? And the fourth and last one is that the tax compliances, because, there's been a claim which the FM also did this time that, the number has come down. Some 2,000 archaic regulations have been dispensed with. But is that really encouraging or discouraging the so-called ease of doing business in India for companies, especially foreign companies? Is that true or false? So that's something which comes from me. And I will now give the floor to Joost Guy from the embassy. He's the Economic Affairs Counselor, a great supporter of the Indo-Dutch relationships and all these chapters we have all over the place. He's been visiting all of us. Thank you, Joost, to always kindly agree to all our requests at the last minutes. And I'm really glad and very, very appreciative. So thank you, and over to you. As I said, we all need a little bit of good words from you, the country, the finance minister, and all of us. Thank you. Joost.
Thank you so much, Rajesh, and good evening to all of you there. Yeah, well, probably, the last minute tactic works quite well, right? Because then we're always with our back against the wall. I have seen many of these presentations, and what I always see, Rajesh and all the others, is, it goes about tax, right? The tax regime, and the 4 questions you formulated are very, very relevant. But as an embassy, you hardly find within the embassy a tax expert, right? Because all the real tax experts are with KPMG and their 3 little brothers. But what we are usually interested in, and also what we usually report also back to our ministries is, what is the long-term view on the economy of India? And in that sense, we are looking usually after the macroeconomic picture, which we see developing in the budgets. And then, I also based myself on a critical NGO think tank, of which the name I don't recollect it, and that we're presenting at our EU economic counselors meeting is, that the government is stressing very much for, let's say, stimulating the economy and trying to crowd in the private investment through big infrastructural projects and programs. And relatively speaking, there is not too much additional investment into education. What we hear from the World Bank as well is that the female labor participation in the country is with 25% not that very high, and that's one of the also restricting points for further economic growth. So what we see else is that still labor the labor productivity is on the low side, and I would be not more interested, but if we could hear today as well from our tax advisor from KPMG what their perspective on these kind of aspects of the general economic development is, because with tax reductions and changing tax regimes, there is also maybe a long-term investment. But is that enough to, well, as you said, Rajesh, to ease the way of doing business in India, and will that provide the long-awaited foreign direct investment also coming from the decoupling from investments in China? So and then there's also the trend that more of the decoupling goes into Vietnam and Bangladesh than into India. So what are also the perspectives on the long term for the macroeconomic development of India? That would be my question. And there I see the lesser attention given, the limited attention given to education, to skill development is I think a point of attention which should be addressed in the coming budgets, and maybe also in the policies of the coming year, because I think there we should do a real good investment for the coming 15 to 30 years. Can I leave it with this as a kind of introduction?
Yeah, thank you. Very relevant subjects. Of course, you touched upon education, the labor productivity, and of course the women power. So I'm sure that KPMG will come back on it. Let me now invite Rob Solinas for introducing the speakers. And Rob is the president of INBCB in Bangalore. Rob, kindly go ahead.
Yeah, thank you, Rajesh. Good evening to all. I'm happy that for the second time I'm participating in this meeting. Last year did it as well, and I think we can be very happy with the participation of some excellent experts from KPMG. And well, I have the honor to introduce them. I'm not going to take a very long time for that, but I will introduce them one by one. As we know, the first speaker will be Prashant Kapoor. He will be talking about the budget highlights and the context setting. The second speaker will be Nidhi Maheshwari. I'm really sorry, probably I don't pronounce the names 100% correctly, but I think you will understand who it is. And she will do the analysis of the direct taxes. As a third speaker, this was added, it was not yet in the program. With the subject of personal taxes, we have Vineet Agarwal, and we will close the session with Khushbu Kandalia, and that is about the analysis of the indirect taxes. So, sorry, let's start with Prashant Kapoor. He has over 20 years of experience in areas such as mergers, acquisitions, corporate restructuring, capital structuring, due diligence, and cross-border taxation. He has corporate restructuring, advisory, and implementation experience for national, multinational clients over a wide range of industry. He has been advising on a wide gamut of tax and regulatory issues involving mergers, demergers, acquisition, restructuring, and divestitures, conducting the due diligence for acquisition and investment. He also continues to be a very active participant in panel discussions and tax seminars, and has also published and contributes to articles for several industrial bodies like CII, FECCI, the ASSOCHAM, etc., etc. I will give the speaker to Prashant, and we'll come back to you later for a second introduction.
You're on mute, Prashant.
Am I audible now? Okay, great. So I think I would like to thank Rajesh, Mr. Joseph, and Rob for setting the context. Actually, in fact, you all set the context while I'm just going to take it further from where you all left. So Rajesh, while some of the pointers which you highlighted, I'm sure between between myself. Okay, so between myself and my other colleagues, we'll try to address some of those points. But with this, I'll just go to start with my presentation, and some pointers which you highlighted should get addressed as we move in. So if I may request to load the presentation, please. Yeah, and if you can be on a slideshow, that's great. So I think just as I move into the context setting, and maybe we can go to slide 3, please. The one after this. The one after this, please. Okay, while the presentation is getting loaded, I think if I look at this budget to address one of the points which I think Rob or Mr. Joseph mentioned, I think we could clearly see this as a progressive budget. This budget was a clear mix of the consumption and the outlay of capital expenditure, which of course is quite essential as we see from an economic standpoint. If we also see from the various initiatives which the government has taken, I think one clear point was the aim to reduce the fiscal deficit. The target of 6.4 is reasonably met, and if we get the numbers correct from where the finance minister was aiming to, I think we are targeting, or the fiscal deficit was getting pegged at 5.9% by financial year 24, and the aim to reduce it to 4.5 by financial year 26. I think that to my mind is a clear win. Specifically, if we see, sorry, can I request the presentation to be loaded? At least I can't see it. Yeah. Okay. If I look at in the backdrop of the certain reduction in taxes, I think this is a clear win for the government to reduce or to peg it down, even to the target of financial year 2023. Some of the other priorities which have been listed, I think a clear focus of moving to green energy, or a transition to a more green energy. Of course, it's an ambitious target. We as a country are far behind from certain other countries, especially in Europe. But I think the clear measures and the priorities which have been outlaid were remarkable. I think there was one question on ease of doing business. Of course, this is one requirement for all the investment, or I would say all the investors, or the various multinational groups looking at India for any bolt-on investments or any further round of investments or even greenfield. I think ease of doing business is something which was very, very critical. And there was definitely a mention of about 39,000 compliances to get eased. Of course, we need to see in the context of taxes, in context of company law, secretarial, but I think all what she mentioned was there was ease of about 39,000 compliances or the provisions relating to compliances, and decriminalization of about 3,400 provisions. I think that's something is a great achievement, because I think that whole approach of getting penalized and looking at de-incentivizing the investors was something which was I would say warranted. And of course, a clear push to the agricultural sector and the infra space. I think these amongst all were key priorities. Of course, there were others. I think there was a mention on the education. I think there was a clear priority on youth power. There was also a clear priority of building India to a more technology-driven and AI-driven economy. I think that's something which was remarkable. So I think with this, I can just go into some specific highlights, and then I would request Nidhi to take up the direct tax or the proposals for taxes as we go along. But just to mention, and maybe if you can go to slide 5, please. Just specific pointers on tax proposals relating to investments or relating to some kind of an M&A or an inorganic growth. If I may request to move to slide 5, please. The one after this. Yeah. So I think this no change in the taxes for selling of shares, or which we term it as gains under capitals. So I think that's something which is very important, because the industry, or I would say there was a general mood wherein people were expecting a tinkering or a change in the regime for taxes. I think that, to my mind, is a big thumbs up, because there is no change, which effectively means that there is a stability, there is a stable tax regime, which of course is most appropriate for investors. When I look at certain changes, of course, there is a specific provision which we call it as investments or a downstream investment by non-residents into Indian operating companies, where there's a threshold provided there, and any premium which is paid into Indian operating companies, at least till now, was not supposed to be taxable as income if the funds have been infused by non-residents. So of course, that provision has been extended to non-residents, which essentially means that we need to be a little bit careful as investments made by non-residents into Indian operating companies, so that it should not get classified as income. Separate regime to tax market-linked debentures. Of course, the non-convertible debentures, or I would say making it listed, was conducive from a tax perspective all this while. But now with the new regime of taxing these debentures as short-term capital gains is something which will, I would not say discouraging, but at least one needs to be a little careful in terms of how you're trying to now put your investments into your downstream operating companies in India. Of course, tax withholding on interest income, which was only available to non-residents, as has now been including to have more in terms of more of a holistic view and including the residents, etc. Also, some measures from a strategic disinvestment perspective, where certain provisions have been extended to include certain sectors. So all in all, I would say an investment conducive provisions. The biggest thumbs up was no changes in the tax regime and more of a stable tax environment. I think that's what the investors needs, and that was a need of the hour. So I think with this, we can go to the other tax proposals. And maybe I would request Nidhi to take up those proposals and explain it to all of us. Over to you, Nidhi.
Okay, thank you.
Thank you, Prashant.
I would like to introduce you, Nidhi. So thank you, Prashant. I think it was a clear and a comprehensive sharing of information on this new budget. And I would like now to introduce Nidhi. She is a very diversified industry, which has a lot of industry experience, more than 21 years already, and a focus on technology and financial services. She has extensively advised companies on corporate tax entry and exit strategies, inbound and outbound investment structuring, and devising tax efficient ownership. She is also known for the active membership of the European corridor and leads the India, Netherlands, India, France, India, Belgium, and India, Italy corridors for the firm. That is quite something. So Nidhi, I would like to give the mic to you.
Thank you, Rob. At least I heard you on mute. But thanks for the intro and a very good evening to all. Happy to be doing this session. Always a pleasure to be addressing this audience. So maybe I'll move to the specifics and building up from where Prashant left off. I'm going to talk about some specific direct tax proposals on the income tax side for corporates as such. If we could move on. If you could move to the next slide, please. Yeah. So, like every year, the budget has some positives and the negatives. Staying on to the positives, if you could please just go back. I think the slides take a little bit time to come up. If you could move to the prior slide, please, the positives. Overall, it has been a balanced budget. It did bring in some changes which were happy changes, but otherwise there were a lot of changes which also were sort of expected and still sort of that wish list actually always remains. So like Prashant said, the good thing is that there has been no change in the corporate tax rates. And this is actually in line with what India has had, because we've already gotten into an attractive 25% tax rate regime. When it comes to startups, like the Netherlands, India also intends to promote the startups a lot. There is a category of eligible startups which has income tax and other benefits. And there was a timeline for them to be set up by 31st March 23 to be able to avail of the tax benefits. That has been extended by 1 year. So they have time to set up till March 24. Also there is an extension of the shareholding change timeline for the carry forward of losses by another 3 years. It used to be 7 years earlier. Now that's been extended to 10 years. On the dispute management side, India has, of course, as most of you would be aware, there's a lot of litigation and pendency, and especially when it came to the matters pending before the appeals, the commissioner appeals, there was a lot of backlog, on account of which, the matters couldn't be dealt with in a timely manner. And in order to address the timelines a little bit and to ease the bandwidth, there has been an introduction of a new Joint Commissioner Appeals Authority to reduce the burden. And this is specified for certain low quantum of appeals pursuant to assessment orders which have been passed by a particular rank of officers below a particular seniority. So this is a good step. At least it will ease the burden and the timelines for appeals disbursements. In order to promote, the MSME sector, there is a provision under the income tax law where, certain deductions are only allowed when you make the payments. And the same has been extended to the MSME sector as well. So which basically means that particular expense will be allowed to the taxpayers only when the payment has actually been made to MSMEs. So this will encourage timely payments to the MSME sector. Now moving on to the next slide. Basically, there were certain areas which haven't been addressed in terms of either the expectations or certain changes which have been made, which were not really such happy changes. The first one really is something which is definitely going to be represented heavily against. And that's basically to say that if there is a share premium received over and above the fair value of a particular company from non-residents, it will be taxable in the hands of the Indian company which is receiving such share premium money. So what happens today is when you issue shares to non-residents, the foreign exchange regulations in India provide for a floor price that you need to at least get in the fair value, but you can get in more money because foreign exchange is coming into India. Now, however, under the income tax provisions, what they've now introduced is that if you receive share premium over and above such fair value, the Indian company which is receiving such share premium could be potentially subject to tax on it. This is a very, very unwelcome move against the whole FDI coming into India as such. And it will create a lot of issues for startups which are getting excessive money over and above the valuations. This is going to be heavily represented against. So let's see if the government takes note of the representations and does something about this before the finance bill is actually enacted. The second box on the right hand side, if you look at, is about the enhanced TCS rates. TCS stands for tax collection at source. This was currently applicable at a lower rate on certain specified payments, but it has now been extended to remittances under the liberalized remittance scheme, other than specified categories, at the rate of 20%. So when Indian residents today make payment outbound, it could be subjected to as much as a 20% TCS rate. In the interest of time, we'll move to the next slide to be able to cover off, the relevant provisions, the key ones. Now, what more was expected? And I spoke about that. Like every year, there is a wish list which obviously doesn't get addressed fully. So if you look at the whole Make in India initiative, there was always an expectation. There is a attractive 15% tax rate for new manufacturing companies, which are set up to 31st March 24. There was a lot of expectation and wish for it to be extended from 31st March 24 to 31st March 25. That has not been done. So it's important for the companies to note March 24 to set this up. Similarly, the production-linked incentive schemes, they had a lot of sectors under its coverage, and expectation was that it will be extended to many other sectors, but such extension hasn't come through in this budget. So that's something which has sort of left the industry wanting for it. Similarly, more incentives to the R&D sector. Nothing on that front also has been announced. On the other incentives, there is a lower withholding tax rate today when you make a payment to non-residents in respect of interest on monies borrowed, and the rate is as low as 5%. Now, this is available under the current provisions only for debts issued up till 2023, 30th June. Now, every year, there used to be an extension of this provision in order to make this a continuing benefit. However, in this current finance bill, no such extension has been announced. So to that extent, it is something which people need to make note of. In fact, today's Economic Times has a full page article on this as well, that it's quite a dampener because what this means is that people will either have to resort to the treaty benefits, which is also subject to a host of conditionalities, or wherever such benefit is not available, the rate of tax is quite high compared to the 5% that we currently had. And lastly, on the digital taxation and other, provisions which we had in terms of equalization levies, significant economic presence, a lot of expectation was that there will be more clarity, because while these provisions are already in force, what's the next step? What's the future of it is something which people were awaiting some clarity on, but that hasn't also come through. So the provisions, they stand as is without any further clarity. Moving on, I'm now going to move to the next set of proposals, which is in the financial services sector, and I'll only restrict to some of the key ones. If we could move to the next slides, please. At least I am not able to see the slides as of now.
Neither we.
Yeah. So if we go to the financial services tax proposal on slide 12, please. Yeah. I'll pick up the first and the sixth one being the key ones in the interest of time. Now, for those of you who don't know, there is a gift city in the state of Gujarat in India, which is basically India's financial services center. And India's aim and vision for it to be to the likes of New York, Tokyo, Singapore, etc. Now, a lot of impetus and incentives are being announced in that sector. One of which was that, there are a lot of dual sort of clearances. So take, for example, if there is a player in the insurance sector, right, a reinsurance player wanting to set up a presence in the gift city, they would need an approval from the SEZ authorities, because gift city is actually an SEZ, as well as the IFSC authorities, the International Financial Services Center. While a lot of other approvals, let's say from IRDA and the regulatory bodies, were merged into it, but these two dual approvals were still required. Now that has been changed to now only bring it under one clearance. So this will indeed become a single window clearance, and it adds to the ease of doing business factors significantly and should provide a lot of boost to the gift city. If I talk about the last point on the sixth box here, the tax exemption on relocation to IFSC by offshore funds. Now, currently, there was an exemption already provided. It had a close date of March 23. Now, that has been extended by another 2 years. So take, for example, a Dutch fund or a Belgian fund, which was to relocate to this gift city in India. A lot of capital assets which get moved, there could be a potential trigger on the capital gains tax side. Now, that has been exempted under the proposed finance bill. So again, a push and a boost to relocation of funds into the gift city from overseas. If we move to the next slide, please. Prashant already spoke of the MLDs. So I'll talk about just a couple of points here. One is, the notified NBFCs. Basically, there are thin capitalization rules in India in respect of debts taken from associates. And there was an exemption given only to the banking industry. It was a representation, and we as a firm were a part of this representation to also exclude the non-banking financial services sector from this purview. And that has been heard by the income tax authorities, and therefore the thin cap rules no longer apply to the NBFCs also now going forward. And lastly, the sovereign wealth funds did not have an ability to take a lower withholding tax certificate. That is something which has been enabled today. And, so therefore it's a welcome step that they can also now avail of this benefit. All in all, a good boost to the financial services sector. The government, the finance minister also recognized this as one of the key sectors of thrust. And accordingly, you have seen a lot of proposals also to boost the financial services sector. With that, I'll hand this over to my colleague Vineet to talk about a lot on the personal tax proposals. And this year's budget has actually got a lot of such changes, so which I'm sure a lot of people are talking about. So over to you, Vineet.
Yes, thank you, Nidhi. And I think it's not easy to make tax regulations clear for everyone, but I think you give a very, very nice and good understandable presentation, which clears the understanding for it. So thank you very much for that. We will now go to Vineet Agrawal. He has over 24 years of experience in advising clients on personal taxation, which is the subject to be speaking about now. He has worked extensively in the area of global mobility and employee taxation, as well for inbound as outbound employees, And he has a great deal of experience, which includes issues relating to exchange control, immigration rules, and the interpretation of double tax avoidance agreements, equity incentives, and social security and retirement plans. He's also a contributor in articles to the Economic Times, Financial Express, and Financial Chronicle, and he features on some business channels as well. So go ahead, Vineet.
Hey, thank you, Rob. The topic that I'm going to discuss today is about personal taxes, something very close to my heart, very close to the wallet. So it's something which is easy to understand as well, if I have to put it this way. But the way I would want to proceed is I would want you to understand these provisions in two different aspects. One, how it hits your own pocket, right? And two, in the capacity of a team or in the capacity of an employer, in terms of, because you will be having a good number of people below you, how does it hit them, and what are some things that is required to be done going forward? Now, what has happened is we used to have a regime where we used to pay taxes, and we generally used to pay, most of the people used to be paying taxes in that way of calculation, etc., which used to be called as an old tax regime, right? Why I'm saying old tax regime means from the financial year 23-24, from April 23, to be precise, we will have a new tax regime altogether, which will be a default tax regime, under which we all have to file our tax returns. And if somebody has to file his tax returns in the old tax regime, he has to opt to do it. So the default will be the new tax regime. Now, if I go with the provisions in terms of any changes, so most of us who were taking deductions, etc., in our tax returns, we are all doing it in the old tax regime. So the news for people filing in the old tax regime is there is no change in the income tax rate, no change in the surcharge in the old tax regime, right? And there is no change in any other thing when it comes to old tax regime. So all the changes which are done is in the new tax regime, right? And in the new tax regime, what has changes have been is the basic exemption limit has been enhanced from 2.5 lakh rupees to 3 lakh rupees. Till 5 lakh in the new tax regime, people were not paying taxes, which has now got increased to 7 lakh rupees. Basically by allowing a rebate to an extent of 25,000 rupees on taxes under a provision known as Section 87A. People drawing a salary of more than 5 crore rupees, that means more than 500,000 euros, right? They used to earlier pay a surcharge of 37%. Now the surcharge has been reduced to 25%, making it an effective tax liability of 39%. So when India says that what is the maximum marginal rate of tax to the outside world, it used to earlier say that our maximum marginal rate of tax is 43%. Now, India will proudly say that it is 39%. Standard deduction, an amount of 50,000 rupees used to be a deduction which was not available in the new tax regime. Now, that is also available going forward in the new tax regime. If you go to the next slide, and when I tried to put across the slab rates, tried to put across the slabs, etc. The more relevant thing now will be the third box, which is there, which is on the extreme right of your screen. So this is where the tax different slabs are there in India now, and this will be the tax rate. So the first box also exists, but the more relevant will be the third box, because I'll get to the details of it in my next slide. Next slide. So getting back to the example of what is a new tax regime means, earlier if somebody was drawing a remuneration of 15 lakh Indian rupees, and try to understand this more from a perspective of your employees below who would be maybe in this range, right? And they were availing a deduction of everything, maybe standard deduction also, loss from house property, multiple deductions in terms of investments, etc. most of the people were opting for the old tax regime only because they wanted to claim the deductions. And even while a new tax regime was told 2 years back, nobody wanted to move because there was not enough bit of savings. Now the savings have increased if somebody is opting for the new tax regime. So if we take these two examples, in both examples, we can see that there is a tax saving if somebody is moving to the new tax regime, which actually will make every person in India to do his own calculation. And if he ends up saving some money, he will opt for the new tax regime. Now, if you go to the next slide, maybe I'll skip this slide because of the numbers. Maybe in the next slide to this. Yeah. Now, there is a magical number. There is a magical number when we talk from our discussion, because there's a lot of Indians also who's there in the call. The magical number is a number of 4,25,000 rupees. If you are taking deductions of more than 4,25,000 rupees in the current regime, then you would prefer to continue with the old tax regime even in the financial year 2023-24. Having said that, if you are claiming a deduction of less than 4,25,000 rupees, and you obviously salary to salary, the numbers could be different, so every calculation will have to be done. I'm talking about something who's drawing more than 15 lakh rupees. If you are drawing a salary of less than 4,25,000 rupees, you would prefer to move to the new tax regime. Now, what does this 4,25,000 include? 4,25,000 includes everything. So in the current financial year, if you are claiming a standard deduction, if you are claiming an investment under section 80C, if you are claiming loss from house property, if you are claiming house rent allowance as deductions, if you are claiming insurance under section 80D, 25,000 to 75,000 rupees, and your sum total at an individual level, was more than 4,25,000, you continue with the old tax regime. If it was less than 4,25,000 rupees, you would want to shift into the new tax regime, and you will see humongous benefits associated. That will require more from an employer point of view, since this is going to be the default regime. As a support to your employees, you will want to let them know or educate them in terms of which regime that they should opt for from April onwards for withholding of their taxes, and obviously they can then take a conscious call when they're filing their tax returns. Maybe next slide. Yeah. If anybody has questions, I'm happy to take the questions. So just pause me whenever you feel it's appropriate. Now, proposed change in capital gains. One very interesting thing that they have done is, while at some point of time they have tried to reduce the surcharge, but at the same time, they are not leaving any rich Indians or any rich residents I would say anybody in India who's selling a property and making a lot of money. So they are trying to cap the benefit associated with it by prescribing certain limits. For example, there are two kinds of benefits which used to happen when it comes to capital gains. One section used to be known as 54, the other section used to be known as 54F. The logic used to be, you sell a house property, you buy a house property. And the 54F used to be, you sell anything and you buy a house property. So what was happening was, a lot of people were putting their money and buying huge house properties and evading capital gains tax. So as per the new change which has come across is, any property that you buy of more than 10 crore rupees, anything above 10 crore rupees will not be taken into consideration for doing the necessary calculation. Yeah. So let's put it this way. Suppose you are planning to buy a house in Jorbagh, or you are planning to buy a house in, say, Chanakyapuri, or planning to buy a house in Murgaon at the Camellias, etc. You would need to think twice whether you are going to get the same benefit by investing in this house from your capital gains, or maybe time to think something else. What is coming across is there are a lot of people who were planning to now buying house property before March 31st. Yeah. Can you go to the next slide, because I've covered it. I've covered the example. Next slide. Yeah. Some more changes on personal taxes, which are very relevant, is the general philosophy of insurance in India was like whatever proceeds used to come from insurance, it was not taxable. And at the same time, most of you will appreciate this point, that always having a term life policy is a very difficult proposition when it comes to an insurance business. So insurance generally then gets linked to a return on investment, and that's how they promote their business. So what the change which has come up in one of the very important amendments is that if people are investing in insurance policies of an aggregate of more than 5 lakh rupees, then whatever proceeds which comes across, anything which is over and above the 5 lakh rupees, those policies, etc., the proceeds which come across will be taxable in the hands of the employee. Obviously, the premium paid will get reduced. Definitely, this will not be taxable in case of deaths, etc. But what is important is for the people who are trying to make it as more like an investment kind of a thing, they are trying to curb this kind of a benefit. It's going to impact a lot of HNIs, but not the typical kind of middle class people. Nidhi covered provisions on the remittance. I just wanted to make that point also, that on the remittance front, if you are remitting any money outside India, now you need to shell out 20% more. So like suppose if your kids are studying in foreign universities, education is a separate thing, but for meeting the daily expenses, if you're remitting any amount that is without any limit, 20% amount needs to be paid as TCS. There is a provision that when you file your tax returns, you can disclose everything and get this 20% adjusted. But the fact of the matter remains that even after some people raising their concern that it's a high amount, the ministry has clarified that this is just done to avoid any leakages, and that will help the government to control these leakages. And obviously, that option is always given that that amount can be adjusted with the tax liability of an individual. On provident fund, a small change that people at a lower level generally don't have a PAN number. So when they end up taking the refund of provident fund, the provident fund authorities in India used to deduct taxes at the maximum marginal rate. Now they have been told to do it only at 20% rather than at the maximum marginal rate. So these are all from a personal tax point of view. Let me hand it over to Rob.
Okay, thank you very much, Vineet. As said in your introduction, personal tax is of course of everybody's interest. And I think your clarification made at least a lot of us think, okay, let's think what will be the consequences for me. So I would like now to introduce Khushbu. She has more than 70 years experience in litigation, consulting, advisory, and compliance practice, and especially specialized in the indirect taxes. She has dealt extensively in the areas of goods and services tax, goods and services tax, custom duty, foreign trade policy, central and state industrial policies, and service tax, value-added tax, central sales tax, etc. She is also contributing not only here, but many times as a speaker in different forums as ICAI, CAA, and other industry forums, and has published some articles as well. So over to you, Khushbu.
Thank you, Rob. Thank you for the kind introduction. Good evening, everyone. So I'll be covering the budget proposals from the indirect tax front. So that basically mainly consists of goods and services tax, customs duty, excise duty for a few selected products and the customs bit of it. Before I get into the proposals, and we may want to go to the next slide, Rob and Joseph, you mentioned about whether the budget is progressive, whether it's conducive to investment, does it help on the ease of doing business, does it have propositions on skills and education, which I think Prashant covered, that there are substantial allocations on the skill development given. But from the indirect tax perspective, the budget, I would say, is very much on the progressive and growth-oriented front. Mainly, so why I'm saying this is, the budget proposals that I will discuss are mainly into three buckets. One is, say, there are a lot of clarificatory changes. Now, how this helps is it helps in reducing litigations. It helps in bringing more clarity, surety, stability to the industry in terms of what tax positions they need to take. The second set of changes which are proposed are more towards simplification, more towards decriminalization. So as you know, the industries were literally scared of the GST regime, and that's what the government has realized and are working towards making it more decriminalized law. In that sense, yes, it is investment conducive. It does give that stability to the businesses to rest assured that for small offenses or small misses, they will not be dragged into the criminal inquiries. And yes, it is also towards more on the growth-oriented front, considering, as you may be aware, that the Indian government is more focused on Make in India, and therefore you will see most of the customs-related changes are towards that growth mindset on how India can be supported more on manufacturing indigenously. So with that prospect, I'll quickly take all of us through the indirect tax budget proposals. Could we please move on to the next slide? I think we've lost the slide. Is it just me? It's not able to see the slide. Thank you. Thank you. So I think we move to the second slide. If you could please go to the first slide. Thank you. So like I mentioned, there are a set of changes which are of clarificatory nature. There was, in 2019, there was one change which was brought to say that any kind of sales which are, say, within the bonded warehouse or the sales which are happening while the goods are on high seas, or you being an Indian entity are selling, say, goods from Singapore to US, those kind of transactions should not be subject to GST. That was introduced from 2019. However, because there were a lot of litigations going on this aspect for the period before 2019, the government has now made that change as retroactive from 2019, which means if there are any litigations pertaining to the GST applicability of any of these transactions, which are out and out transactions, those litigations will stand resolved and these transactions will not be subject to GST. The second similar change is again on the transaction of sales which happens within the bonded warehouse. So say, for example, the goods are imported, stored in bonded warehouse, and from there sold to the buyer within the bonded warehouse itself. The law proposes now to construe it as an exempt supply. It was always an exempt supply, but to bring in line that parity that if GST is not applicable on it, the GST ITC, the input tax credit, which is the set off in GST, will also be not available. While this is an amendment in the law, it is more of bringing that parity into picture, where if something is not subject to GST, the credit pertaining to the same should also not be available. The only singular change which in the entire proposition appears to be restrictive is this particular change, the point number 3, input tax credit of GST is restricted for CSR obligations. Again, In a way, this is also more in terms of parity, because the CSR activities of a company are not for their business. They are not, so to say, the GST taxable business or services, and therefore the law now says that any ITC pertaining to the CSR obligations of a company, the GST ITC shall not be available. The next change is again in the nature of more so clarification. There were some changes, not getting into details of it, there were some changes which were made in 2019, 2021 to bring that clarity of what is the place of supply for certain supplies of transportation services from outside, for goods going outside India, where the supplier and recipient both are located within India. Due to certain internal government clarifications, they had indicated earlier that the place of supply will be the destination of goods outside India. Again, this had led to a lot of confusion on GST, ITC, input tax or set of availability, and which now stands clarified. That entire confusion or the proviso which created confusion is removed. And therefore, now it is clearly laid down that if there is a supplier in India and providing transportation services to recipient in India, and if the goods are going outside India, the place of supply will be the destination outside India. Another similar change is on the online information and database services. So this is more, these are more so the services in the nature of, say, Netflix or the Amazon Prime Video, etc. kind of services where the database is outside India and an overseas entity is providing those services or providing access or retrieval of that data to the entities or to the users in India. Earlier, they were covered to the extent of those services provided to an Indian consumer who's a non-GST registered user. Now that stands changed that even a non-registered business is receiving these services. The foreign entity providing those services will need to register in India and pay the taxes. Another clarificatory change in the same kind of services where, for example, if there is an overseas entity who is, say, providing data or who's providing online tutorial to the consumers in India, again, there was that lack of clarity in terms of what is called minimal human intervention, what is called automated service, and therefore all of those needs for clarification are removed. In fact, those clauses itself are removed, avoiding any confusion for the future. Another similar change was earlier, if say you are a business who is into completely GST exempt supply of goods or GST exempt supply of services, there was a lack of clarity or there was a lack of, I would say, appropriate provision to indicate whether these kind of businesses need to register themselves if, say, for example, they have a reverse charge mechanism liability in GST. And again, to avoid these litigations and confusions, it is clarified or the provision is changed to indicate that if there is a completely exempt business in terms of their outward supply, they will not be required to register just because of any other provision or just because they become liable to GST as a recipient of a service. We may move on to the next slide, please. Yeah. So now the changes that we are discussing are more on the decriminalization as well as making the compliances a little more clear. So there is an outer limit of 3 years which is provided for filing of GST returns. So far as we speak, there was no outer limit. The returns which are not editable once filed, but if they are not filed, they can be filed for a number of period. Now that seeks to be limited to 3 years. Another very important step in terms of the technological advancement is automated sharing of information within various government systems. So while the law already includes a provision which says that, say, income tax can talk to the GST department for data, this particular provision brings to forefront the technological means, so to say that if, say, for example, you've filed the returns on GST portal, the data in those returns can be exchanged to any other government portals. The good part is that this is subject to the consent of the supplier and the recipient, depending upon what the data contains. Prashant also spoke about a lot of decriminalization related provisions being put in. So as you may be aware that the GST revenues have been increasing, and in fact this last month was the highest revenue of GST on by the government, and therefore that is very much reflected in this set of decriminalization provisions, which indicates that government is fairly stable and comfortable with the kind of compliances they are seeing now, and they no more want to have that criminal effect on the provisions or on the minor non-compliances or offenses. So this is how it goes. If there is a tampering of a document or a destruction of an evidence, if a departmental officer is prevented from his discharge of duties, whereby, you know, say for example, the datas are not submitted, the summons are not adhered to. So all of those kind of offenses are removed from the prosecution. This still remains an offense, but not a prosecuted or not a prosecution worthy offense. In the same direction, the prosecution threshold limit, which was the lowest limit was 2 crores earlier, which is now made, which was 1 crore, which is now made 2 crores. So up to an offense of 2 crores, the prosecution will not be launched. And that also is except only for the fake invoices. So if there are an invoice involving fake invoices, issuance of fake invoices, which is clearly offense under the GST, in those cases, the prosecution can be launched up to 1 crore. In the rest of the cases, it will be 2 crores. Compounding of offenses, whereby an offense of prosecution can be compounded against a particular payment of tax, those limits are also reduced. I will not get into the limits of the amounts because maybe not too relevant. There are certain penal provisions introduced for e-commerce operators. E-commerce operators, say for example, are supplying goods of a non-registered dealer or a dealer who is under composite and doing interstate supply. They'll be liable to penal provisions now. We may please move on to the next slide. For the want of time, I will not get into too much of details of these changes, but these are the set of changes now which are more towards growth-oriented changes. Like I indicated, India wants to more concentrate on the Make in India, or so to say, Atmanirbhar India, whereby more and more manufacturing in India is encouraged, and therefore there are certain customs duty increases which are seen in the finished products which India wants to manufacture on its own rather than importing. As a corollary, even if there are some inputs or raw materials which are required for manufacture of those finished goods which India wants to manufacture, the import duty rates of those raw materials are decreased. I will, for the want of time, not get into the details of what are those products. There are a lot of classifications in the customs tariff which are changed. This is again more of a rationalizing change, whereby international standards and the Indian standards are made at par so that the imports and exports are more easier. The exemption list, which was earlier provided, is revised. There are a few new exemptions which are introduced. There are a few exemptions which are discontinued. The more important change in terms of exemption is earlier the government had brought in to effect an amendment which said that every exemption in customs will expire automatically in the end of 2 years. But now, on having revisited those, A few of those exemptions are removed from this automated exemption withdrawal, and those exemptions, which means will stay for more than period of 2 years or until withdrawal. You may have heard about the issue of solar power plants, whether they fall under the project imports and therefore they can be components of the same can be imported at a lower duty rate under project imports. There was a lot of confusion, and government had also indicated that they are not going to provide any concessions for these imports, which now stands as the law amendment, and therefore any import in relation to solar power plants components will not be qualifying for concessional customs duty rate under project imports. The rest of the changes, I'll not get too much into details of it. They are very minor and nothing major to be discussed upon. I think with this, I close on the indirect tax bit of proposals. My apologies for the being conscious on the time. I may have run through the proposals a little quickly, and I'll be open to any queries that are there. Thank you.
Thank you very much, Kuzbo. I think it was another very interesting presentation.
Rob, can I take over from here?
Yes, of course.
Yeah. Thank you, Rob. So I think let me thank all of you first of all, but obviously we'll have a formal vote of thanks later on coming from Rajiv. And before that, the Q&A session to be handled by Amit. I'm aware of the time constraint, but I cannot not raise a few flags which come to my mind, just in case any one of you wishes to answer them. And of course, also bit of curious on one other point. I think 4 things which come to my mind which have not been adequately covered, and obviously all of us have a wish list going into each year. One of them is the rationalization of the transfer pricing regime, because I find that to be quite onerous, both international and domestic. The second thing, of course, you mentioned about the share premium being taxed, especially with regard to startups, and someone treating that as gift by foreign funders. That's, I think, going to be extremely hard on the startup community. So that's something which government has to deal with. The other thing which is there is the tax, long-term tax on the unlisted shares, which we've all been expecting to come down to 10% on par with the listed ones. But here, there is nothing which is happening. Again, we expected last year, this year, but it remains unfulfilled dream. And the fourth one is on GST. I think, Khushbu, you dealt with it. But one thing which remains for us, like fund managers, on the carry interest, that question still looms large, that carry interest payments are subject to GST. And that's going to be a huge impact. 18%, 12%, whatever it is, it's awful. So I personally feel very, rather disappointed. And the other thing which is extremely, maybe one of you should attempt answering, that's a question which I guess none of us can, individually can answer. When you look at the tax to the GDP ratio in India, it's about 11%. Overall, it's about 34%. So clearly, everybody wants to widen the tax base to be able to improve this ratio. In a country like India, where 60-65% population is involved in agriculture, and the agriculture income is exempt from tax largely, how do you really expand this tax base? I think it's a very enigmatic question, which I think crosses everybody's mind. So I'm personally, very, very expectant that let's see how this tax to GDP ratio can go up. Let me leave it here and hand it over to Amit. And I don't know whether, Amit, you have any question in the chat box, but if not, maybe you have a question. And otherwise, I have raised some of them anyway. So somebody can from KPMG can answer them. Thank you.
Yeah, thank you, Rajesh. And I think if someone from KPMG is answering them, or these are more like issues, I mean, your expectations from the budget probably. Yeah. So I'm actually sorry for joining in late and missed the initial part of the presentation because I was between.
You came right at the right time when your role starts.
Okay. So, but I made a request on chat box for anybody if they have a question to raise. I definitely have a one, which is a small one related to database access. But from the members, if anybody is having a question, they are free to raise or put it on the chat box. Deepak ji, you have something? No. Okay, so nothing have come on chat box. Yeah.
So let them comment on my comments.
Yeah, please.
Go ahead.
Rajesh ji, a quick one from my side. Yes, the GST on carry interest continues despite the represent.
Work to do for the Indian Venture Capital Association. Okay.
See, Khushbu, I am having a question. We are making a representation to the government on GST part on warehouses. I'm actually involved with logistics industry and where we are warehouse developers. So is it a possibility if we negotiate with the state, then the state GST can be waived off and could be, I mean, is there a possibility as an incentive? Because we are in discussion as an association with one of the governments.
I think we do have a disturbance. I'll request the participants to mute their mics. Yeah, so Amit ji, while the GST authorities, so you may be aware that every GST change is approved by and deliberated by the GST Council, which sits at the center with everyone's participation. Coming to so anything that needs to be changed in the GST law will need to go through the GST Council. You may want to represent through the law committee members of the relevant state. However, yes, on the state front, the state may not be able to exempt the GST in relation to warehousing. But yes, it may give you a reimbursement of the SGST portion which is levied on the warehousing services. So essentially, where it is a warehousing service involved, if that is a service, that should be subject to central plus state GST because the place of supply will be the relevant state, and there will be a state GST levy. So you can approach the relevant state authorities requesting them to include you either in the state industrial incentives policy or set up a policy or state a policy separately for the logistics sector and provide the reimbursement of the SGST front. Having said that, any exemption requested becomes actually enti the business because the moment your services are exempt, all your incoming GST ITC becomes a cost. So ideal option should be the second one, going to the state authorities for an industrial incentive policy.
Okay, I understand. So see, we are warehouse developers. So developing warehouses, whatever GST we pay on the building construction or the construction related activities are cost. I don't get them as an input credit. So this was exactly my proposal before the government that the state GST can actually be offered as a reimbursement to us because they have been offering a lot of benefit like stamp duty exemptions, subvention of the interest and all those. So that is, we have just proposing it. So I just wanted to be sure that it's possible as a reimbursement, it can come to us. If we,
it is completely a prerogative of the state authorities to provide this kind of an incentive, but nevertheless, a representation can always work. Separately, on the very matter, you may be aware there is a decision of Safari retreats, which as we speak is before the Supreme Court. As I understand, if I'm not mistaken, the next date of hearing is 15th February. So there should be some judicial development also on this front.
Okay, thank you. Rajiv ji, you have a question, Rajiv bhai? You are muted, Rajiv ji.
No, Amit, I have no question. Thank you.
Okay.
Deepak
ji raised his hand. Yeah.
Okay. This question is regarding
Amit, I just wanted to convey that I would appreciate if you can also do the word of thanks because I'm just walking into a meeting because it got a bit delayed. So I just walking into one, but it's been a pleasure to attend this.
Good evening to everybody from Calcutta. It was a fruitful session. Khushbu-ji, thank you very much. All these speakers, we really enlightened. Thank you very much.
Deepak-ji, you had to say something?
No, it's okay. If you have concluded, I'm okay.
Okay. So I think Rajiv left, and the responsibility to convey the vote to our speakers and is resting. Is there anything from the forum? I think Harish Lalwani ji raised his hand. Harish bhai?
I thought you have already done vote. Thanks. If not, then I can ask my question.
No, I think Harish, let Harish bhai speak. He's just
Okay.
After that, Harish bhai, we can come to you, Deepak ji. Yeah.
Yeah. Good evening, everybody. I am from INBA Mumbai, and my question was a very general one, asking that during the COVID times, a lot of companies could not fulfill all their GST requirements, and some of them actually had their GST numbers which were I think they were frozen. Now, during this time, have they come up with something for such companies, who have actually had genuine problems and would like to come back or pay their charges, or is there some kind of a scheme that has been offered to such organizations? I know it's a very general question. It's nothing to do with any individual over here, but I'm sure there are a lot more companies in our industry, which are stuck because of these things. So is there something that we can tell them?
So, Harishji, we did hear that they were planning amnesty scheme in GST, and the expectation was that there'll be some kind of announcement during the budget. Having said that, yes, none of those announcements are made in terms of any kind of amnesty for GST. In fact, it was expected for customs also, which we've not actually seen culminating. Separately, sir, during this period, for the delayed filing of returns or payment of taxes, from time to time, they had extended the due dates and they had given a few relaxations. But as we speak, none of the relaxations are going on, because things are more or less on track since last 1 year or so.
Great. Thanks. That's just what I wanted to know, because there are, as an association, that's something that we also need to answer to them. And of course, I'm in logistics, so they didn't do anything for the freight. That's what was very disappointing, because we still have to pay that 5% trade GST on freights, whether it's imports or exports. And yeah, I guess that's it. That's it from me. Thank you very much. I'm sorry I came in a little late, but whatever I heard, I think you'll passed on the information just perfectly. Thank you very much.
Deepak ji, you had something to...
Okay, I also have a question for Khushbu, as a general question again. All the exporters get GST refunds, and let's say some small payment doesn't come. It could be any amount, $1,000, $2,000 in a particular month. What should that export company should do? Can they leave that entry and get it later on, or they should not take refund for that particular month? Those are the questions which just came to my mind.
So, Deepak ji, you meant that the proceeds towards the exports are not received, or the refund of GST is not received?
No. To get proceeds of refund, you must get 100% payment. Let's say some payment is stuck for, let's say, for any particular month of $2,000 or whatever it could be. So how does one tackle that? Because you can't take refund for that month or for that quarter.
Sir, actually, the way the GST refunds work, though, yes, it is a condition that you should receive foreign exchange within the prescribed time, your application of GST refund or the automatic route of GST rebate need not wait for receipt of the payment. And therefore, if you are in the automated route of rebate, whereby simply filing the shipping bill, you will get the refund. There, your receipt of proceeds will not become an embargo at that point. However, later, if you are sure that you are not going to receive those proceeds within the prescribed time limit, then you will need to pay back that refund.
Okay, so Amit, maybe Chakra from Hyderabad is here. Maybe he can also do a quick thank you, and then we all have thank KPMG all around.
Yeah,
So,
I think that would
Chakra,
be nice. Chakra can do
Chakra,
this, yes.
are you here?
Chakravarti ji, he was here a few minutes before.
I think maybe he just sent a message to from signed off. Okay, go ahead and wrap this up. I think it's already about 6:30, so time to.
Okay, I think a lot has been said in a small session. So all because of our distinguished speakers and the experts from KPMG. I would like to thank them for being partners for this budget session. And of course, it has been very interesting one, though I missed the first part of it, but it's okay. And of course, I would like to thank Oost from the embassy, who has been kind enough to join and open the session. And of course, our participating chambers, IBLCCI from Mumbai, INBA Bangalore, and INBA Hyderabad. All the presidents have attended the session, and I'm thankful to BLBA for collaborating this. And has been an interesting one. If I mean, we'll get back to KPMG in case there is any query coming in, we can send them on email, and would love to hear their response. Thank you once again. We can wrap up the session now.
Thank you very much.
Thank you. Have a good evening, all of you, and great follow on to the budget. So let's see. We will hopefully will after the finance bill is passed. Maybe it's a good time to catch up again. Let's see how many concessions are made from here to there. So in the manner of speaking, we'll also have an FPO. Thank you.
Thank you all.
Okay,
Thank you all.
bye-bye.
Thank you, everyone.